Okay, so what I'd like to do is make it deliverable to iterative. So you guys are putting it together and showing it to me like every week that you're starting to build it. All right, so that by the time it's due on the Thursday the 21st, it'll be really high quality. Because I can't really wait anymore. I've been kind of relaxed, on the first deliverable for some people, but I really need to start, having some hard and fast deadlines. So I've been pretty flexible, but I need you to really focus on the due dates. And then you need to show me, the first draft of the deliverable Tuesday or Thursday on the 12th and 14th, and the second draft review on Tuesday, Thursday, the 19th and the 20th, and then the final deliverable due on November 21st. Okay, is everybody clear? Yeah. And then again, let me just go through this. What I'll do is I'll upload the videos. I should have gone through, all of the quizzes for everybody, identifying some additional submissions, fixing of the deliverable 1. So you need to get that signed off if you haven't been signed off yet, and or give me the corrections and everything with deliverable 2. So I want everything done for the first 2/3 of the class. Okay, and again, the deliverable 2, you're going to have the cover page. I'd like to have 5 memos. So again, give me your memos so that I can edit them. And then the homework problems. The chapter presentations. Remember, the chapter presentations need to be 3 slides per page with the notes, so you can get it. The economic article memo, you can give me that as soon as possible so I can read it. And make sure you take it to the writing center to edit it, to make sure your subject verbs and grammar and punctuation, spelling and all that stuff is corrected. And then the research paper and presentation draft, you should be getting me that as soon as possible so I can start doing some edits. And I would take it to the writing center too and have them review it every single time. Right? As you start to build it, you should be having it reviewed constantly by them. And then the take-home midterm, I'll leave that. And I don't mind if you guys work together on that. And then the in-class midterm and the notes, you're doing the notes right now. And then I'll give you an in-class midterm, which will take 1 class session. And then your resume, and then that's it. Any questions on that? Is everybody clear? Okay, cool. So we have 1, 2, 3, maybe 4 presentations. Keep going. Okay. All right. So we have 3 presentations today. So you ready, Esteban? Okay. You want to stand up when you do the presentation. Okay, and then you can, if you want to, move in and point at specific stuff on the slide, and then walk back and go to the next slide. So get a little bit more interactive, with the presentation, and point out some of the key points. If it's that important, point it out to the audience. Okay. Let me do the introduction. Menlo College, Econ 201, Microeconomics, Presentation 1, Take 1, and Action.
My name is Esteban Ramirez, and today I'm going to be talking about business ethics effects on enterprise values and stock prices. So, commercializing corporate social responsibility. So, corporate social responsibility narratives influence consumers to believe their purchase, even if it's overpriced, will contribute to societal problems. Typically, global crises are used in these campaigns, but are often misrepresented, so it's easier for the consumer to believe that they're contributing through a purchase. If corporations represent global crises through a method where you can see how your purchase directly contributes, it'll increase profits and be really beneficial to society.
Great. And just speak up a little bit and project out a little bit more, because you're selling us this concept.
So the influence of business ethics and corporate social responsibility. So ethics in business is a growing phenomenon that is starting to become popularized in work environments. Businesses that promote ethics, people are more likely to buy their products because of the ethical practices. In turn, if citizens discover that a business uses unethical practices in their environment, it will negatively impact the consumer's decision, causing them to purchase a different product. So we're going to go into the ethos bottled water paradox. So an increasing type of marketing seen within large corporations is cause-related marketing, where a corporation and a nonprofit organization collaborate to promote sales and the cause. After further analyzing campaigns initiated by Ethos Water, they influence people to think the solution to the water crisis is through consuming ethically branded water bottles. Only 5-cent donations are made for every purchase, but how would buying plastic actually help solve the water crisis?
And you want to make sure that where you have cause-related marketing, that you capitalize the C, the R, and the M.
So going into some of the data that I found from the research, cause-related marketing involving water for water initiatives has increased in the early 2000s, and in the U.S. alone, $11.7 billion was spent on bottled water, and people increased water consumption from 5.5 liters to 112 liters in 2011. So the reason that's really significant is 59% of people would switch to an ethical brand, and that was a study that was conducted in 2013. And Ethos Water campaigns are expected to reach over 40 million Americans since they're owned by Starbucks and distributed by PepsiCo. So they're putting out their message almost all over the place.
Now, was that 59%, was that mentioned in the article from the article research, or were they referencing another article?
I think they were referencing another article.
Yeah, you want to make sure that you put that in as a reference in your paper.
So into the methodology and statistical models utilized. So they didn't really use too many models, but the primary thing that they followed was the use of cause-related marketing campaigns. And so the researchers used previous knowledge from within that industry to conduct a deep analysis on Ethos Water campaigns, primarily focusing on how they communicate through text and images to explore initiatives and portrayals of the water crisis. Analysis also included systematic online searches, press releases, and interviews. So in the picture here, this is one of their ads that they use a lot, and so Ethos Water quenches your thirst and verse 2. So all they're really saying is that if you purchase water from them, it'll give them water, but all they really do is just make a 5-cent donation out of their $1.80 bottle. So some significant variables. So within cause-related marketing models, water is the most popular to use, and the amount of pictures that are displayed that depict the water crisis are limited throughout all of their campaigns. So if you were to go on their website or anything, they really have like almost no pictures. There's like a handful. And bottled water purchases are increasing every year. So cause-related marketing can directly influence corporate responsibility, marketed philanthropy, and ethical consumption. So these were the results that the researchers found. Ethos' water's marketing strategy displays the water crisis as lack and luck, emphasizing that the issue is missing infrastructure. Their campaigns don't really focus on why it's happening, they more focus on what's happening because of it. They also fail to pinpoint where the crisis is, claiming that it's happening everywhere, but it hasn't reached the U.S. quite yet. They describe it as an elsewhere problem. So consumers are encouraged to purchase to help alleviate the cost, yet only 5 cents out of the $1.80 cost is donated. So this paradox is created where you're buying an unsustainable product for ethical consumption, even though it won't really benefit anything. That's all I got.
Great. Do you have any, and at the end of the presentation, you want to make sure that you ask if there's any questions.
Is there any questions?
Yeah, it's crazy how like water gets privatized like that, and it should be like for me a human right that everybody has like water, like basic right. And they kind of capitalize from using problems that are used like people that don't have water. They sell it as like a marketing strategy. Only like 5 cents you donated, that's crazy. So
Yeah,
not much of a difference.
they're just using it to profit. Well,
That's
Evo's
supposed to be.
water, when it was initially created, was actually really beneficial because it was 50% of their proceeds would actually go to organizations. But then once it got bought by Starbucks, that was when their marketing campaigns kind of changed, and that was when it went to 5 cent donations. So they started profiting more once it got to get benefits.
So when Starbucks purchased it,
Yeah.
good presentation.
Okay, what I'm gonna do is I'm gonna do the, Neil, I'm gonna do the my presentation, because I have an evaluation today, and then you guys can do your stuff on Tuesday. Okay? Thanks, Esteban. That was a great presentation. The presentation I'm gonna do for you today, and do you guys have your blue books?
Yeah.
So make sure that you take the notes. So what I wanted to do for you guys today is put into context a lot of the theories that you already learned, in this class in microeconomics. Some of the stuff in the presentation you have already seen in your pretest and your quizzes. With this presentation, this is a presentation that I made at a national conference about a year ago, or a little over a year ago. What we were looking at was really the impact of central banking, the Federal Reserve. You've learned about, inverted yield curves and, the impact of rising and falling interest rates on stock prices and, bond prices. But this is a paper or a presentation that looks at central banking effects, on real estate prices, in particular in real estate cycles. We have a real estate center here, and we have a major here, so this is directly applicable to the program. So what I had to do, what you'll learn, is that when you represent a company, and I represent an investment management company, that you're going to need to have a disclaimer, because I can't be representing, some of the things that I talk about are really my views, not the views of the organization, particularly financial services corporation, so you have to have a disclaimer of the information. You don't have to have a picture of me and my cat, but I thought that was a pretty good picture of me and my cat. And actually, we fed him some cat food and he went bald. It was awful. It took like 2 years for his hair to grow back, but he's doing fine now. Okay, let me do a little introduction. So, efficient real estate and security capital markets, really the microeconomics of real estate and security capital markets, require strong public and private sector cooperation, really government with the private sector. Disclosure of government and corporate financial conditions. You need to really know what policies are being enacted by the government so that businesses can plan and adjust from those policies. And you need institutional, individual investor confidence in both the financial system and political institutions. And we're really playing through a lot of that right now. But this is really the hypothesis that is a necessary condition for well-functioning capital markets for wealth accumulation. these are the major takeaways from the research. What we found out is that real estate prices are highly correlated with the overall business cycle. That monetary policy, which is a macro factor, under and over accommodation has a direct impact on commercial and residential real estate prices. So when the Fed, lowers interest rates significantly, a lot of money is injected, into the system. That system lowers interest rates and inflates asset prices through the stimulative effect in the economy. What we found is that over accommodation from central bank policies on a global basis exacerbated the real estate price cycle. So what we found out over the last, particularly over the last 20 years, is that as interest rates have moved down significantly, that they caused real estate prices, both residential and commercial prices, to become, in some view, overvalued. The next real estate recession, and I'll show you some of these, some of the theories. The negative price shocks on the real estate market are forecast to occur between 2021 and 2023, with a recovery between 2024 and 28. This is probably one of the most important things that investors are really looking for, is forward guidance from people like yourself as economists. They're going to want to know what your opinions are and what your forecasts are, based on not only the economic theory, but the data that you use to conduct your analysis. The next real estate recession will be caused by quantitative tightening. We saw quantitative tightening occur over the last 2 years. Quantitative easing has actually started again over the last 2-3 months in what is called the repo market. But that quantitative tightening, if the Federal Reserve raises interest rates too fast and too far, it's going to shock the system and cause maybe a recession, but also corrections in the real estate price cycles. And we've already seen, and you guys have learned from your first exam, is that the yield curve inverted about 2-3 months ago. And we know from the lectures that once the yield curve inverts, the stock market peaks within 24 months, and we usually fall into a recession within 24 months, which puts you in that 21 to 23 period. So what we also found was rapid technological, demographic, economic, and cultural, and sociological and political change has changed the way central banks analyze, manage, and respond to business cycle peaks, troughs, and recessions, financial crises, and macro-prudential bank supervision. Central bank policy responses failed consistently over time due to limitations in the data, models, ideology. Epistemology is really the philosophy in which central banks actually make policy decisions. The bureaucracy and politics. And currently you're seeing that the Federal Reserve holds about 12% of all government debt through the printing press. So the Federal Reserve will print money to buy those bonds to drive up bond prices and drive down interest rates to stimulate the economy. And what we found is that historically the Federal Reserve would raise interest rates too fast, too far to cool inflation and end up pushing the economy into a recession. We also found asset price bubbles and asset price collapses through fiscal and currency crises have become more frequent since 1995. So if you go back and you look back since 1995, you can see that there's been more crises, financial crises, economic crises, and the Federal Reserve has been there to basically pump more money into the economy to lower interest rates to try to re-stimulate the economy. And you can see the 95 was the peso crisis, 97 was the Thai baht crisis, 98 was the Russian default, 2000 you had Y2K, and 9/11 in 2001, you had the housing bubble in 2006 and 7, and you had the financial crisis in 98. In 2008 and 2009, that then lasted through to 2010 and 11. We also found that central bankers do not have the intellect, culture, knowledge, data, models, tools, resources, balance sheet to deal with crises going forward. The consensus by most economists now is that the fiscal side, the treasury side, we have $22 trillion of debt outstanding currently. We will be running a $1 trillion deficit per year going out, every year for decades. So it really limits the ability of governments to stimulate the economy through spending and taking on more debt. So we may have already reached a debt limit. And then the Federal Reserve has lowered interest rates so low and kept them low over the last 10 years that if we fell into a recession and they need to stimulate the economy, they would probably have to drive interest rates negative, which the United States has never done, but other countries in Europe and in Asia have driven their interest rates negative, which is very damaging for savers in particular, and may be beneficial for investors and maybe businesses in the short term. What we've also found is that, and you guys have gone over this, is that because of these financial crises and economic crises becoming more frequent, that it introduces more systematic and structural and economic and market risk. So you as business managers, which you will be very soon as you make that transition from academia into the private sector, you will be confronted with more systematic risk, more market risk, more political risk. So the question is, as you manage your assets and you manage your liabilities and you manage your portfolio of assets, how do you manage through more systematic risk? And the answer to that is you take on more non-systematic risk or more business-specific risk and push down the systematic risk. And the way that you do that is you focus on your business. You focus, it's the 80-20 rule, you focus on the 20% of your clients that generates the 80% of your revenue. You really focus on customer service. You hire the best talent. You deploy the best technology. And you really focus on the quality of the products and services that you deliver to those clients and lock those clients in. What you also know, because we went through this in class for the quiz, is that you can bow out the efficient frontier. You can lower the expected return on your portfolio and lower the risk significantly in your portfolio, thereby increasing the risk-adjusted rate of return by introducing alternative assets into your stock bond portfolio. So as we went over before, which we went over on the quiz, is because these alternative assets, their returns have low, no, and negative correlation with stocks and bonds. So if you add these alternative assets to your stock bond portfolio, again, it's going to bow out the efficient frontier. Yes, it's going to reduce the return, but it's going to reduce the risk even more than the reduction in the return. So your risk-adjusted rate of return is going to go up. And you as investment managers, if you can build these portfolios, and you can provide your clients with a 10% rate of return based on the rule of 72 divided by 10, you're going to be able to double the money in your portfolio or in your client's portfolio in 7.2 years. And that's really the goal. If you can do that, you've really provided a real service, to your clients or your company. We also, on the pre-test and in the exam, we went over the development of forecast models and the factors, using either cross-sectional or time series regression models, that we can build models to be able to do forecasts. And the dependent variable that I'm really focused on with my clients is really the value of real estate. Is the value of real estate going to go up or down? That's the question that they constantly ask me. And where should I be investing, or when should I be investing? So the dependent variable in all of these models is the value of real estate. That's what we're focusing on. And each model has, again, remember, no more than 5 variables within the regression model. And there's gonna be variables in one model that are also gonna be in the other models. So this is a very dynamic forecast model that really needs to be solved simultaneously, okay, using simultaneous regression solutions. And obviously there's gonna be an error term. But what you're learning in your business degree is you're learning that you can forecast the value of real estate by understanding the accounting factors, the financial ratios, and both managerial and financial accounting variables. In finance, you're using finance, you're rolling up the financial statements into the financials, and then showing those financials to potential investors to raise capital in both the debt market, bonds, and the stock market, equity. You also need to understand the economics, the fiscal policies and the monetary policies that are occurring at the macro level, because they will have a direct or indirect impact on the value of your real estate and your bonds and your stocks. You also need to understand, and this is really what's playing out right now in Washington, is really the political dynamics, because it's really politics that formulates the policy, that then the policy is then brought to the 2 chambers of Congress. They are reconciled between the Senate and the House, and then the policy is then brought before the President, either for veto or signature. Once the policies are signed into law, they are then administered through the bureaucracy, or through the institutions, and those policy outcomes will have a direct or indirect impact on the value of not only you as human capital, but also the value of your real estate, your stocks, and your bonds. So it's really policy impacts have an impact on the economics. So you're studying the microeconomics right now, but it's really one layer up is the policies, and once the policies are enacted and enforced through the bureaucracies, it will have the microeconomic effects. You know, it will shift back or out the supply curve, or it will shift up or down the demand curve and have the effect on not only quantity produced, but also prices. Okay? And then if you look back historically on how our democratic capitalistic system is really set up, you can see that it's really based on law and based on institutions that really taken from Western Europe and European societies. And if you look at the legal system based on precedents and the philosophy, which is Western civilization, out of Europe, you can even see that our society and our institutions, along with European society and institutions, are replicated based off of theological systems that have been around for at least 8,000 years. So if you understand that within each one of these disciplines are variables that you can use to forecast the direction of real estate values or stock values or bond values or even your own human value, you need to be able to solve this simultaneously using the regression equations. And you can do that now using big data applications. The advancement in technology through cloud computing, now quantum computing, allows you to be able to program and solve this in real time currently. What allows this system and your ability to be able to solve this simultaneously is basically the standardization in linguistics and language, English being the standard communication language for business on a global basis. Our psychology and sociology is really standardized too. If you look at the way people are dressed at a middle class level on a global basis, we all communicate in English, we all basically dress the same, the cultures are pretty much standardized. So it makes it really easy to relate and communicate to people. And now with technology and communications, you now have basically, you're the most powerful generation on Earth and probably in history, because you basically have advanced technologies, which are basically supercomputers in your pockets. That allows you to not only search and get data and information quickly, but also to be able to communicate individually, but also in networks, which has never been, we've never had this before in history. And then lastly, it's just really cognition, and logic. I mean, you're learning, you're here, learning at the academy, you're learning the logic and the theory around the business cores, and your cognition, your capabilities to learn and then apply the theory allows you to be able to do that. You can't do that in other parts of the world. I mean, you can't do that in Idlib, and you can't do that in other parts of the, maybe parts of Iraq, because the institutions have collapsed. So you here right now are in a really good position to be able to learn everything and move forward more decisively, to make decisive decisions as a business professional. Any questions on that? Okay, so this is basically your intellectual operating system. What I found too, and you guys are familiar with these discounted cash flow models, because again, you had that on your quiz, with the perpetuity or constant growth model, multiple model, and the discounted cash flow model. What I found is that the volatility in asset prices, bond prices, stock prices, real estate prices, was being driven by really volatility in the discount rates. Not the volatility in the cash flows, but really volatility in the discount rates. So really asset price volatility is really coming from not only monetary policy, but also inflation expectations. And we learned about the Fisher equation earlier in the class. So the question then becomes, again, from a microeconomic standpoint, what is the discount rate, or how do you construct the expected rate of return to get the discounted cash flow valuations? So what I did was I went back and looked at, well, if I was going to construct an expected return to use as a discount rate in my perpetuity, constant growth, multiple discounted cash flow model, how would I build it? So the first thing I would do is start with the risk-free rate, which, as you know, using the Fisher equation, the nominal interest rates and the real rate plus inflation expectations. So that's basically your base rate in constructing it. And you may be asked at some point in your firm, I've been asked multiple times, what is the discount rate that I should be using to apply to these cash flows to come up with the intrinsic value? So you start with the base rate, and then you add on inflation risk premiums, credit default risk premiums, illiquidity risk premiums, and again, the longer the life or maturity of the asset, the more illiquid it is. Maturity risk premiums, again, the shorter maturity instruments are less risky than longer maturity investments. And if you're on a global basis, investing overseas or in international companies, you have a currency risk premium and currency exchange rate like we did, the exercises on the dollar to the pound and dollar to the euro. And then tax risk premiums. I mean, there's tax legislation that's being proposed to lower capital gains. We saw not an overhaul, but we saw some tax changes a couple of years ago. And we saw some tax changes years before that too. So as tax rates go up, they're going to have a direct impact on the valuation of those assets. And if tax rates go down, then the valuations will go up. And then the two risk premiums that I think have been ignored for decades, that are now really coming into play, is political and policy risk premiums. Not only fiscal policy and monetary policy risk premiums, but also political risk premiums. And you're seeing that play out right now, that are having direct effect on the markets. And there was a survey that was done by Goldman Sachs that basically they surveyed their investors, and their investors said that more than 30% of high-grade corporate bond investors listed populism and politics as their biggest concern for the next 12 months. So now the political risk premiums are being tacked on to the base rate, causing the discount rate to become more volatile, and theoretically discount rates should actually be higher than they actually are. the reason why discount rates or expected returns are so low is that the Federal Reserve has driven this base rate to basically zero. And the Federal Reserve has also looked at driving these interest rates negative, like they've done in Asia and like they've done in Europe. Yes, go ahead.
And we're seeing populism movements in almost the whole world, right?
Yeah, exactly. And it wasn't really, it was more party politics, more centrist party politics, not only from the parliamentary systems, but the representative democratic systems, even though ours is really the only one.
Yeah.
Most democratic capitalistic systems are parliamentary systems. But you're seeing, yes, you're seeing populism in lots of countries right now, which is creating the risk premium, which theoretically is driving up discount rates, which theoretically should put downward pressure on intrinsic values for stocks, bonds, and real estate. But we're not seeing that yet, particularly in the stock market or the real estate market, or really even the bond market.
Is it gonna affect the market?
Theoretically, it should, but I don't think there really is enough research around this, because this is really kind of a third rail of research, you know, for a lot of economists, you know, to start to, you know, run political analyses that has a direct impact on discount rates and then a direct impact on asset prices. And a lot of maybe political economists would take on this research. With monetary policy economists and other economists would try to avoid that. So what were my research questions and hypotheses that I was trying to test? So what were the monetary shocks on real estate prices? Well, one was excessive over-accommodation, really low interest rates, and high money supply growth rates, you know, that are gonna increase the monetary base and expand it. What is the impact, or the excessive accommodation has a direct impact on real estate prices. Real estate prices right now, particularly rents and home prices, particularly in the Bay Area and other supply-constrained markets, are at an all-time high because interest rates have been so low. Implementation of zero or negative interest rates and quantitative easing, the expected and unexpected positive and negative policy supply shocks and accommodation, direct lagged impact on global real estate, commercial, and residential home prices. This is what we're trying to find. And in the forecast, implementation of positive interest rate and quantitative tightening. What is the expected and unexpected negative policy supply shocks or restrictions? And what is the effect of, you know, inverted yield curves? So these are some of the factors that I was looking at. So obviously you have to get data, right, to be able to conduct the analysis, and then be able to come up with the research results to then, you know, make your conclusions. So data comes from multiple sources. We can get interest rates and money supply data from the Federal Reserve, from the district banks, and on a global basis from the Bank of England, the European Central Bank, Bank of Japan, and the People's Bank of China. These were really the countries that I was looking at. And then capital market information, we were looking at equities, real estate securities, fixed income, capital markets, residential mortgage-backed securities and commercial mortgage-backed securities, real estate private equity markets and indexes. We were looking at closed-end, open-end, and single account data, macro and micro market factors such as mortgage flows into commercial real estate markets and residential. And also we were looking at space market factors too, such as vacancy rates and rental growth rates. The economic data we were looking at to really track the business cycle is gross domestic product or industrial production. Gross domestic product comes out on a quarterly basis. Industrial production comes out on a monthly basis, which actually does a better job of tracking the cycle. We looked at employment, not only labor participation rates and unemployment rates, but also real wage growth, which was really key. So really looking at wealth. And then money supply and actually the velocity of money. And I'll go through this. Also, the data sources, the Bureau of Labor Statistics, the Commerce Department, US Census, the Bureau of Economic Analysis, and then other data sets and data providers. So lots of data. The microeconomic data that was looking at was from two companies. One was from Real Capital Analytics and CoStar. These are the two real estate data providers that will give me the data I need to be able to track the real estate markets and the real estate cycles. And they gave me transactions data, price data, they gave me price indices, and they also gave me data all the way down to the individual properties and individual submarkets. And then CoStar gave me some of the same data and some of the building attributes, so I could do another layer of analysis and build these regression models using the building attributes and look at macro factors, effects on individual properties, which is extremely valuable for building owners. So the results we found is that government policies has made the real estate economy worse off, driving the cost of capital to zero and negative. So there's a big debate right now going on by the major CEOs of large money center banks on what the short, medium, and long-term effects will be on driving interest rates negative, and we talked a little bit about that earlier in the semester. What we're seeing is a replacement of real assets for financial assets. What we've seen, the printing of trillions of dollars to bail out and purchase bad debt and defective financial products. You're seeing it in Europe right now too. We've seen it in Europe. We continue to see that, allowing massive leakage of capital to flow unregulated through the shadow banking system. What I'll show you later in some of the data is that the velocity of money, remember when we went through that in class, which is the number of times money circulates in the economy, has basically collapsed because the system, as you print money now, as the Fed prints money, it leaks and is injected out into the global system. So that money doesn't circulate within the United States system, it is injected, it leaks out into the global system. So now monetary policy is less effective than it used to be. With no real effect on real asset pricing, economic growth, wage growth, labor participation, inflation, standards of living, or social welfare. So through this over-accommodation by the Federal Reserve, we should have seen some effect, which we did, on asset prices. We saw some effect on economic growth. Gross domestic product grew at 3% in the first quarter. It slowed significantly in the second quarter. 2017-18 was around 3%, which is the Fed, what it was targeting. But prior to that, since 2009, GDP was well below the 3% target. If you look at wage growth, it was just only recently that you saw real wage growth, which means that rising standards of living, because people are now making generating income above the inflation rate, which deteriorates purchasing power. We're now finally starting to see more people come back into the labor force. We talked about labor markets last week. You're starting to see labor participation rates start to move up for the first time in at least 5 or 6 years. Unemployment rate is at an all-time low. We saw last week that the unemployment rate on a national basis is 3.4%. And here in San Francisco and along the peninsulas, 1.8. That's frictional unemployment. Inflation, the Fed is targeting 2%. Obviously, we saw last week that the inflation rate here was running at about twice the national rates, about 4%. The Fed's targeting 2%, but they haven't really hit their inflation targets, so less effective. And then we have seen some. Until recently, we're seeing, falling, standards of living and social welfare because labor participation rates were so low, and you really saw no real wage growth for years or even decades for some segments of the economy. Any questions on any of that? No? Is everybody following along? I think it's a lot of the stuff that we've already reviewed. So let's look at the business cycle. So what we did, and I got this chart from a friend of mine. He basically looked at the business cycle. Yes, sir.
It's already done.
Oh, is it? Okay.
I have to leave 11.
Oh, you do?
I have a
Okay.
next class, okay?
Okay.
You go ahead. Okay, thank you.
No, well, we're done. I'll carry on the presentation. Probably next week or something.
Thank you. Thank you for letting me come in. Thank you for.
Okay, well, did you want a piece of cheesecake or something?
I'm fine, thank you.
Okay, there you go.
You have your thing here, right? This is here.
Yeah, I'll want that back as this is.
Thank you. Thank you.
So hopefully that gives you an idea. Okay, take care of yourself. So I'll continue to go through this, and you can take notes and stuff, okay? Yeah, so keep,